All right, welcome. Today, we're prying open the Professional Analyst's Toolbox. We're going to equip you with the absolute must-have tools for figuring out what any company is really worth. So let's get right into it.
So here's the big question, right? It's what every single investor, consultant, and analyst has to figure out. You see a stock price on the screen, but what is that number actually telling you? Is it a fair deal, a total steal, or is it a bubble just waiting to pop?
And to find out, you got to look beyond that flashy price tag. You need to look under the hood. And that's exactly what we're doing today, building you that analyst toolbox piece by piece so you can see what a company is truly worth.
Okay, the very first thing we have to get our heads around is the foundation for this entire toolkit. It's a simple but powerful idea called relative valuation. And honestly, it's all about context.
And you know what? At its core, it's actually super simple. Think about it. You would never, ever buy a 3-bedroom house without first checking the prices of other 3-bedroom houses on the exact same street, right? Of course not. Well, in finance, we do the same thing. We find a group of similar companies, we call them comps, and we see how the market is pricing them. That gives us a benchmark for the company we're looking at.
But, and this is a big but, this method is not foolproof. I mean, what if the entire neighborhood is caught in a massive housing bubble? Then your comparable price is just as crazy and inflated. It's the same with stocks. If the whole market is overvalued, your relative valuation will just tell you, yep, this stock is also overvalued. It's a fantastic technique, but you have to know its limits right from the start.
All right, let's grab our first tool from the box. This is the one you see literally everywhere, on the news, in stock apps. It's the PE ratio. Think of it as the trusty screwdriver of the valuation world. It's fundamental. So what does it actually mean? Well, a PE of, say, 15 means you're paying $15 for every single dollar of that company's annual profit. It's a really direct way to see how the market feels about a company's ability to make money. A low PE could mean it's a bargain, while a really high PE usually means investors are betting on huge growth in the future.
And here's the trade-off. The PE ratio's greatest strength is that it's simple, but that's also its biggest weakness. It totally ignores a company's debt, which is a massive piece of the story. And since it's based on net income, it can get all twisted up by accounting rules. Oh, and for a startup that isn't profitable yet, this tool is completely useless.
Yeah, that blind spot around debt, that's a huge problem. A company might look super cheap based on its PE ratio, but it could be drowning in loans that you just can't see with this tool. To fix that, we need to upgrade from the simple screwdriver to something with a lot more power.
So let's bring in the big guns, the EV to EBITDA multiple. If PE is the everyday screwdriver, think of this as the professional-grade power drill. This is what the pros use for the really heavy-duty work, especially in things like mergers and acquisitions.
And this one is a total game changer. Let's break it down. EV is enterprise value. That's the company's market value plus all its debt minus the cash it has on hand. It's basically the real price to buy the whole company. And EBITDA is just a fancy acronym for earnings before interest, taxes, depreciation, and amortization. By using these two, we're comparing the total cost to buy a business to its raw, pure, operational earning power.
And this is why it's so powerful. It lets you do a true apples-to-apples comparison of two companies, even if one is loaded with debt and the other isn't, or if they're in different countries with different tax laws. But, and this is the killer flaw, it ignores capital expenditures. That's the money a company has to spend on things like factories and equipment just to stay in business. For an airline or a car maker, that's a massive expense that EBITDA just kind of pretends doesn't exist.
Okay, so you don't always need a power drill for every job, right? Sometimes you need something more specialized, and that's where our next couple of multiples come in. These are for very specific situations.
First up, price to book. This is your go-to for companies whose value is all tied up in physical stuff, tangible assets. Think of a bank, where the value is really in its loan book. But for a software company, its value is in its code and its brand, things you can't touch, so PB is pretty much useless there. For that unprofitable, fast-growing tech startup, you'd pull out the price-to-sales ratio. It's often the only tool that works when there are no profits to measure. The huge catch? A company can have $1 billion in sales and still be losing $500 million in cash. PS doesn't care one bit about profit.
So you've got the tools. But listen, knowing what a screwdriver is and knowing how to actually build a cabinet are two very different things. Now we get to the masterclass, how to use these tools like a real expert.
This is probably the most important technique a pro uses. It's called normalization. See, a company's reported earnings can be really messy. Maybe they had a huge one-time gain because they sold a factory. An analyst strips that out because it's not part of the normal, repeatable business. The whole point is to clean up the numbers to find the true, ongoing profit engine of the company. This is what separates the rookies from the pros.
Okay, so this table right here, this is basically your cheat sheet. It pulls everything we've talked about together. You can see each tool, what it focuses on, its biggest weakness, and the perfect job for it. PE for a quick check on profitability, EV/EBITDA for deep operational comparisons, PB for businesses heavy on assets, and PS for those high-growth companies with no profits. Yet. See? No single tool can do it all.
And that brings us to the #1 most important rule of valuation. Seriously, if you forget everything else, remember this. A good analysis is like building a legal case. You need multiple pieces of evidence. Using just one multiple is just lazy, it's malpractice. You have to look at the company from all the different angles to build a strong, defensible argument for what it's worth.
Okay, for all you future consultants, bankers, and analysts out there, this next part is especially for you. We're going to package all this knowledge up so you can walk into your next big interview and just absolutely crush the valuation questions.
Here are your 3 golden takeaways. 1. Show them you see the big picture. It's about a mosaic of multiples, not just one magic number. 2. Know your stuff. EV/EBITDA is the pro's choice for comparing core operations because it's capital structure neutral. And 3. The pro move. Drop the keyword normalization. It immediately shows you think deeper than the surface level numbers.
And you can bet you're going to get asked questions just like these. Think about them. Pause and work through your answers. Based on everything we've just covered, you have all the pieces to put together a brilliant response for each one. This is how you prove you don't just know the definitions. You know how to actually use the tools.
So we filled your toolbox for analyzing the companies that exist today. But the final question I want to leave you with is always about what's next. These tools, they were built for a world of factories and profits. As value shifts to things like data, AI, and network effects, the next great challenge will be adapting this toolbox, or maybe building a new one from scratch to value the innovations that will define our future. Thanks for tuning in.